how to take trading and automate it. So I'll give you a bit of a background of how this happened, what are the components that are required to be able to automate trading, some of the considerations, and a bit of a history of how this has evolved over the last few years. Question, who's involved now with electronic trading, algo trading? There we go. Good. Good, good. All right, so let's see. So let's jump right into it. This is the US equity market. So it's a market that has evolved very quickly over the last few years to be electronic. You could almost see the inflection point here when electronic trading came in. It basically caused an explosion of volume in the market. So the volumes increase, the quantities increase, the velocity of the speed increase. And that's happening with all the instruments. If you look at this, that's bonds, repos, futures, everything is going the same path. And if you look at other regions, including Europe, the path is exactly the same, it's just shifted. It's delayed by a couple of years. But we're seeing the same pattern everywhere markets trade. So a brief history. If you look back at markets as a whole, there have always been two forces that change the market. Either advances in technology or changes in regulation. Going all the way back to the ticker tape. Before the ticker tape came in, if you wanted to know what the prices of a stock were at a particular time, you have to physically stand at the floor of the NYSE. That's the only way that you could get real-time pricing. You have to be physically present there. When the ticker tape came in, you could be sitting in California or in a different country, and you could actually get a near real-time feed, so the market expanded. Other people could participate. Same thing with technology. Technology keeps advancing, and new technology, cheaper technology, faster technology changes the market as well. With electronic trading, these two things join forces. So the regulators in the late 90s decided that they wanted to open up competition to the exchanges. So they came in with Reg ATS, which basically said you can set up an exchange with a very light infrastructure, fully automated, to create competition. At the same time, computing power became very, very cheap. I remember the first ECN that was created, which is Archipelago. I was working at Goldman Sachs at the time, so they sent me to look at this new thing called an ECN. I went to Chicago, they had a small office, and went up. There was literally 3 guys and 4 PCs running Linux. This was the first ECN. So it was very cheap to set up a new exchange back in the late 90s because regulation allowed it and technology enabled it. What's happened since then? Fragmentation. If you look at this chart, I think it's a great chart. In 1995, the percentage of market share of NYSE listed stocks was close to 90%. That's the only place you could really trade. That's where the liquidity was. Today, it's less than 20%, fluctuates between 15 to 18%. Now we have 12 exchanges, I think 13 now. We have over 50 dark pools that you can trade on. So it's been an explosion of places where you can trade. Over half of the value nowadays is also algo generated, meaning the algorithm is making decisions on when to enter and when to exit the market. So why is this important? Because if you're going to automate trading, you need electronic markets. First, you need to be able to get market data in real time. If I don't know where the market is now, I cannot make a decision of what to do next. And I need to get data immediately, as quickly as possible. This is the way that exchanges used to keep the monopoly. They would not share the data. If you wanted the data, you have to be presently at the exchange, you have to buy a seat at the exchange. You cannot set up an algo trading on a floor. So this is important. The second piece is you need direct access. So I get the price, I make my calculation, I make a decision. I need to be able to go to the exchange and trade electronically. If I put something in the middle or someone in the middle, my model changes. If it takes me too long to go to the exchange to buy or sell a stock that I want to buy or sell, the price could move, liquidity goes, I could be chasing prices all day long. So I need those two components to be able to automate trading. First, real-time pricing, and second, direct access. What has done this for the financial industry? Over the past 10 years, over 1,200 brokers went out of business. As you can see, the volumes have gone up. And yet, over 20% of the brokers went out of business. Why? Because in an environment when somebody leaps strokes forward and is able to compete faster and better, you have two choices. You have to invest and get up to par to be competitive in the market, or you exit the market. And that's what we saw. The guys that are in the market today are trading huge amount of volume compared to those days. They're quite profitable. And the guys who couldn't keep up just simply exited the market. This is a good point. I typically hear market failures, flash crash, things related to the market going crazy, tied to electronic trading or automated trading. This is as old as the markets. If you look at this report in 1962, this is if you were reading a headline for today. Basically talking about the barrage of orders coming in, it couldn't be handled, the market moving quickly. It goes back as old as the market's been functioning. What the electronic trading and automated trading does, it just compresses the time frames. Okay? So what's a trading bot? Very simply, it's a computer program that is interacting with the market. It could be as simply as, if the price of IBM goes to 10, buy. That's an automated trading strategy. A simple one, but that's what it is. But it could be as complex as, I'm calculating a signal, I'm looking at market inefficiencies. When that happens, go into the market. When it flips, get back out of the market again. The constant, I don't know why this keeps flipping automatically here. Sorry, guys. The constant in this is that you need to have direct market access. Without direct market access, there's no automated trading. Okay? Started being used as cost reduction. Automate things that were repetitive. Then became defense mechanisms that eventually became ways of generating more profit. What does it take to automate trading? It's really the intersection of three things. It's knowledge about the market. It's mathematical models that you can apply, and then it's a technology infrastructure. If you look at most operations that do automated trading nowadays, they are structured very similarly. The teams sit together. You have mathematicians looking at the mathematical models, people that know trading, traders, and then you have technology people who are working together. You need to have all three things working together for this to be successful. There's a fourth one as well that is not here, which is operations. If you're trading and you're trading a lot of volume, something happens, you need to have operations come in and figure out what's going on. When is it more useful? Typically when the limits of human abilities begin falling short. When is that? Fast markets. The market is changing very, very quickly. It's very difficult for a human to be able to be calculating things in his head and to react in the proper time when markets are moving very quickly. It's when there are too many things to trade. If there are 10,000 instruments that are trading, I can only pay attention to 3 or 4, maybe 5. But I cannot pay attention to 100 trade instruments or 1,000 instruments. And each one of these instruments are opportunities. There are 13,000 instruments that trade in the US. Then you add derivatives, FX, bonds, option, futures. The list is endless. And each one of those things is an opportunity to trade. Or when too many opportunities occur at the same time. When I was at Knight Capital Group, one of the first things we wanted to do was automate trading of the positions. We're the #1 market maker, but we wanted to increase the level of automation. And I would take every day, look at the P&L of the firm, find the trader that made the most money. Next morning, I would sit with him at his desk, and I would ask him, how do you do it? I mean, what's your secret to be the #1 guy yesterday? How do you make all this money? They always gave me the same answer. I sense the market. I have a sixth sense, I have a lot of experience with this. I know when to get in and when to get out. While I was talking to them, I was looking at what they had on the screen and what they were looking at and when they would go in and out of the market. And it was always the same story. They were looking at one or two things. They were either looking at an index, they were looking at a similar stock, they were looking at their book, they were looking at the positions, but there were always one, two, or three things they were looking at, which makes sense. It's impossible for somebody to focus in too many things that are changing very rapidly. So that's how we started. We began automating those things that they were looking at. This is a rule of thumb. If you want to know roughly what the opportunities to trade in the market are, pretty straightforward. How many instruments are trading in the market? How many trades occur during the day? How much volatility it has? How much is going up and down? And how many hours the market is open? It's a very quick rule of thumb. If you want to see whether the market doesn't move, if it's always a flat line, there's really nothing to do there. If there are too few trades, there's nothing to do there. But if you have a lot of instruments, a lot of trades, a lot of volatility, and a lot of hours, that's a great situation. 3 primary types of strategies. If you look at the strategies currently in the market, I would say 95% of them fall into one of those 3 categories. They're pretty straightforward. There's always nuances, differences, secret sauces that people add to this, but most of them fall into these 3 categories. They are either momentum strategies, which is simply follow the market, figure out what the market is moving and follow it. Mean reversion, go against the market. I think the market now is not what it should be, so I'm going to get in and then get out when it goes back what it should be. Or statistical arbitrage, having a mathematical model that tells me when a relationship should be constant and how to get in and out when the relationship is out of whack. Momentum, very straightforward. You want to detect when a market is going to make a move. You want to get in as early as possible, ride that movement. When it gets there, get out of the market. This is a typical sample. It's an indicator here. The market is bearish. I'm going to get in there selling. Right when it switches, I'm going to switch positions. Try to get in, ride the market, and get out. Many flavors of this, many different indicators you look at. Most people end up with a mix of these plus more indicators, but the core is the same. I want to detect the move, get as early as possible, ride the move. Mean reversion. You're basically looking for one of 3 things. Either the market is overbought or oversold. So again, it's in a state of imbalance. The market or the instrument is above or below my theoretical value. Again, there are many ways that people come up with theoretical values. Or third, you detect extreme optimism or pessimism. What do all 3 of these have in common? That they've caused an imbalance in the marketplace or in an instrument. The instrument is not where it should be, right? What do I do? If the instrument is lower than it should be, I'm going to buy it. If it's higher than it should be, I'm going to sell it. Get an example. You have an indicator, and then you have the market price. If it gets away from the indicator, you buy. When it goes back, you sell. I'm not trying to simplify this, but the core concepts are pretty straightforward. The implementation changes, the mathematical models changes, but the basic premise of mean reversion is exactly that. Statistical arbitrage. This is basically when you find a relationship between two instruments. It could be two stocks, it could be a future and a stock, it could be an index and the components of an index. And you say, when the relationship is broken, then I'm going to take advantage of the fact that the relationship is broken and it's going to go back to stay where it should be. Okay? I'm going to give you guys an example. Some examples of that is pairs trading, which is pretty widespread. Index arbitrage, ETF arbitrage, which ETF is really a tradable index, or multi-America arbitrage. You know, if the stock is listed in New York and is listed in the London Stock Exchange, it should always have the same price when you factor in the FX. Not always. If that this balance, I want to take advantage of that. Very simple example. Let's assume you have two instruments. They're all supposed to be very similar price. So numerator is A, denominator is B. 2, relationship is 1, right? Because they typically stay in sync and they move in sync. At time 2, one of them goes to 4, the other one goes down to 1. It's an imbalance. If I look at historical data, they should always go back to where they should be, which is 1. So if this happens, I buy the one that is here, and I sell the one that's up, right? Next step, they flip again. What do? I sell and I buy. What's my P&L? I sold this at 4 and I bought it at 2. I bought it at 1, I sold it at 3. P&L is going at the moment of the imbalance and getting out when the imbalance finishes. Similar situation here. You know, imbalance, you sell the one at 4, you buy the one at 3. They go back to stability here, then you reverse the trade. So I sold at 4 and I bought at 2, I made $2. I bought at 3 and sold at 2, I lost $1, my net is $1. So you're always taking advantage of a broken relationship, and you found that relationship looking at historical data. Okay? Any questions so far? Am I going too quick? No, that's good. So I'm going to walk you through some of the evolution of algorithms because I think it's interesting. Because it's a path that no matter which algorithms came into the market, they all followed. So typically start with automating a task. Typically either a boring task, a difficult task, something that takes too much time, something that doesn't give a lot of value, right? And it starts typically with pretty stupid automation. And when you do stupid things in the market will go back and take advantage of you. So it moves to the second phase, which you call obfuscation. I'm going to hide my strategy so people don't know what I'm doing. And finally, it ends up with what I call optimization. I'm going to optimize my function of my algorithm to do the best possible way depending on the market conditions. I'm going to walk you guys through an example. This is probably the first set of algorithms that came into the market. It's called VWAP. VWAP is volume weighted average price. Why is VWAP important? Because it's a measure of a fair execution, not the best execution, a fair execution. So this is the VWAP, for example, for Netflix. This is the red line. And basically, as you can see, it's pretty much along the middle of the market. This is Netflix during the day. This is the VWAP. It's not an average. If you look at this here, the first 1, 2, 3, up to 7 trades have the same volume. Since they have the same volume, the VWAP and the average are exactly the same. The next trade is 5,000 shares. the VWAP gets impacted, the average doesn't. So the VWAP accommodates for volume. So it's called volume weighted average price. Finally, we end up with a VWAP of 125.93 and an average of 105. So it's average weighted with volume. So where the volume went in the market. So initially, like most VWAPs, they started as automating a task that was boring. Most people were executing VWAP by taking an order, splitting it in 15 minutes, 10 minutes, 30 minutes intervals, and have the trader manually send an order for that amount, for that, that interval to the market, wait another 15 minutes, send another piece to the market. Pretty repetitive, pretty stupid. So the first time that these things were automated, simply did exactly the same. An order would come in, it would split it in pieces of 15 minutes, and every 15 minutes on the dot, it would send, 1/8 of the order to the market. Great. It automated a task that was complicated and repetitive and boring. It allowed those guys that were doing this to do something else. They didn't have to do this boring task. It allowed the bank to do many more of these things because now it's automated. It can do hundreds of these things without any problem. But the market noticed it. So the market, the counterparties in the market say, wait a second. This guy came in 3 times every 15 minutes for this amount. He must have an order that is this size. So I'm going to start raising the price. I'm going to start taking advantage of these guys. I know companies that at the early stages of algorithms were only focused on detecting VWAP strategies and taking advantage of this. Because when you can predict what somebody's going to do in the marketplace, you can then take advantage of them, right? So this happened. What's the reaction? You begin randomizing the placement of the orders. You begin hiding your intentions. So I'm not going to do every 15 minutes. I'm going to do in a range between 30 and 25 minutes. And I'm going to change the price. I'm not going to give the amount. I'm not going to give the same amount every time. And I'm going to start hiding my intentions to the market. Because I don't want other people to see what I'm doing. And I don't want them to take advantage of me. So it's improved VWAP execution because the VWAP improved. What did the market do? They began improving the ways of detecting VWAP algorithms. It's a funny one called poke, poke, slap, which is basically an algorithm that would send an order specifically to a market maker. It would take whatever they were showing. If the order refreshed for the same amount, they would do it again. And if it refreshed for the same amount, they would send a huge order to basically push out and drive out the VWAP orders. So the sophistication of the counterparties increased as well. Reaction, then you begin getting more sophisticated. You begin developing curves for every single symbol. You begin to figure out what are the times of best liquidity, when should I get in, when I get out. The whole process becomes a lot more analytical and more optimized. So this seems to be working pretty good. What's the problem with this? Anybody can tell me? What's the problem with automating rules-based trading? Anyone?
The rules need to evolve.
That's exactly it. An algorithm, and I would say the great majority of the algorithms today, is what I call if-then algorithms. If this happens, do this. If this other thing happens, do this. And it's someone's idea at the time that the algorithm is written of how the market should be. So it's static. It doesn't evolve. It has all the benefits and the biases of whoever created the algorithm. It doesn't evolve with the market, right? This is a problem because markets always evolve. Markets are always changing. So this is a problem, and I think a lot of the problems that we have seen with algorithms are derived by the fact that they were written, given a set of assumptions that at the time could have been valid, but when the market does something crazy, and the market always does something crazy at some point, two things happen. Either the algorithms go crazy, right, generate huge losses, or they shut down. Neither one of those two is a good option. I was talking earlier about one of the most famous situations with algorithms going crazy. A Knight Capital Group, a couple of years ago, they updated the algorithm. The guys that were doing the updating didn't quite understand how it worked. They rolled it out in production. And for 15 minutes, they were putting the wrong prices. The rest of the market was very happy because they were getting great prices. They lost $700 million in 15 minutes. 15 minutes. Because they did something stupid. They did it many times. And the market said, great, give me the money. I'll take it. So this is probably the main issue. You don't want to have a static approach to a dynamic environment. And the markets are very dynamic. They're always changing and always evolving. So what's the machine learning approach to this? As I mentioned to you, machine learning tends or is here to be able to address those issues of static models. You know, you have 3 layers of this. You have artificial intelligence. You have machine learning, which is basically extracting the models out of the data. And then you have deep learning. I would say most people currently in trading are in the first level, in artificial intelligence, with some machine learning coming in now. So why machine learning now? It's been around for a long time. Since probably the 50s, and probably the mathematical concepts of machine learning have been around for even longer than that. So why now? What's happening now? But right now, you almost have like a perfect storm. You have data, and data storage has become really, really cheap and plentiful. You couldn't amass this amount of data before. You couldn't access this amount of data before quickly. On the opposite side, you have parallel computing. You know, Spark has made a parallel computing programmer out of everyone. I mean, it's incredible what you could do. Before that, you had to spend huge amount of time programming for specific hardware to be able to do parallel computing. Now it's easy. It's pretty straightforward. And then you have cheap storage and CPU, which drive everything else, the computational side. And then you have mathematical models which have improved. Why have the models improved? What are the 2 things that make models better? There are 2 concepts that make models better always. One of them is more data. The more data you throw at a model, the better a model could get. Either because you're backtesting over longer periods, or because you're adding more variables to create richer models. So that's number one, more data. And the fact that we can store a lot of data cheaply nowadays enables that. The second, the faster I run the model, or the more I run a model, the more I can tweak it. If it takes me 20 hours to run a model, I can only do that 5 times a week. If it takes you 5 minutes, you can do that 10 times in a day. And every time you run the model and get a result, you can come back and tweak it. So there's 2 things: throw models and evolution of models into a hyperloop. And that's what we're seeing right now. We're seeing a renaissance of machine learning because you can throw a lot of data models, you can run the model quickly, and you can run them very, very effectively with that cheap CPU as well. How good is this for trading? It seems to be a pretty good fit. Number one is a closed system. What do I mean by that? You don't want to be throwing all kinds of esoteric data into a model because you don't know what the results are going to be. Trading is fairly well delineated. You know what goes into trading. You know what variables are going to affect trading. So you have a closed system that allows you to be able to build models which make sense. Second, you have clearly defined boundaries. You know, you're not going to be mowing the lawn with this. I mean, you know exactly what you need to do. You have a single reward, P&L. Can't get any more clear than that. If you're looking at trading and building models for trading, the only thing you really care about is making money. So you have a single reward. Next, you have a manageable set of predictors. What's a predictor? Predictor is a variable that you can throw in a model, that is going to affect the outcome of the model. Again, we're talking about trading. It's a finite amount of predictors. It's not thousands of them. It's not two, but it's a fair amount and it's a defined amount. So that makes our modeling easier as well. Time scales are typically short. You can find out pretty quickly whether a model is working or not. There's a lot of data that gets generated every day. And finally, you know, the market every day in the US for equities only generates about 40 million tick-related events. Each one of those events is data. And every day is a new set of events. So you have continuously new data that you can run, tweak, test, run your models on. Questions? Good, you guys are quiet. Why? Analysis that used to take hours now take minutes. Like I mentioned to you, backtesting over a large amount of time makes models better, more suitable to odd events. More data sources are available. There's been a whole new industry that's been created over the last couple of years of guys literally harvesting new data sets to sell to hedge funds. And they're coming up with all kinds of crazy data. And it's a new thing. Hedge funds are looking, okay, give me as more data as I can, satellite, credit card transactions, sentiment analysis, you name it. Again, why? Because the more stuff you throw at a model, the more likely you are to have a better model. Let's walk through an implementation of a model here. Are we in time? Oh, wow. 25. The interesting part is at the end, and I want to make sure we get to cover it. So I'm going to skip to some of the things, guys. Hold that. I want to show you some of the start here. A couple of things you need to look at when you model trading. Slippage, which is basically if I see a trade, can I actually get to it? It can actually change dramatically a model. And second one is liquidity. If I see a price and an amount, can I take the full amount from the market or not? And third is market impact. What are my actions going to do in the market that are going to change the market? And there's some strategies to deal with that. But there's things that can actually change dramatically a model. Retraining the model. I want to get to this. This is important. Once you have a model that is working, then you enter into the next process, which is optimization. What's optimization? You want to make sure that the model behaves in a way that is consistent with your risk tolerance. So things that you want to look at is the size of each position you're willing to take. How many total open positions do I want to have? What's going to be my stop loss? When am I exiting the market? Max drawdown, which is basically what's my appetite for the maximum amount I'm willing to lose in a day. Max losing days versus winning days. All these things need to go into the pot once you have a model to tweak it down further so that it works for you. So I'm going to give you an example. This is an actual example. It's a hedge fund. They agree for me to use their data as long as they don't tell you who they are or what the strategy is. But I think it's pretty interesting. So this is the trading. It's actual trading P&L for a month. Pretty good, 1.21 million in profit. Winning versus losing days. So for every 1.5 days I win, I'm going to have a losing day. Not bad. The thing that bothered them were these things here. In the middle of the day and they're losing $60,000, they get nervous. I'm like, should we get out? Should we stay in the market? Is the market not going to come back? And you can see the P&L distribution here. You have 3 days with 60,000 plus losses, 1 day with 40, 3 more days with 40, with 20. So the process was, how do we take this and how do we smooth out the losing days? So the approach is pick out the tick data, rerun through the day, right? And then simulate what the realized and unrealized profit was at every single tick of the market. So every moment in the market, you know what my P&L is, and my potential P&L would be if I sell the positions or buy this position at the moment, if I'm short, okay? And then you go back and simulate what it would happen if I were going to have a max loss or a max gain of different values. In this case, there were 90 decent values. So, and I'll show you, you will be able to see this graphically. And then finally calculate the Sharpe ratio, which is the risk-adjusted P&L. So let's take an extreme example. Let's say that I'm extremely averse to risk. I don't want to lose money. I only want to make money. So what do? You put the stop loss at 1,000. The symbols are switched. It's actually minus and plus, but this a nuance of the strategy, so just follow me along. So stop loss is 1,000, and stop gain is open. What does it mean? If I'm losing $1,000, I'm getting out. I'm not going to do anything in the way up. I can make as much money as it is, but I just don't want to lose money. So if you look at here, the curve smooth out. See? There's no big losing days. All of these guys are probably 1,000 or less than 1,000 or about $1,000 because he hit the stop and off he goes. So the winning versus losing days gets really bad. But it's not very big. But it doesn't look good, right? So obviously being extremely risk averse doesn't work. The P&L, it's not bad, $778,000. I was at 1.1. Safer, but it just doesn't look good, you know. This is exactly opposite. Let's say I'm willing to take some losses, but the minute I make $1,000, I want to be out of the market. I'm just looking to make a little bit of the money in the market every day. I make $1,000, I'm out, and I wait until I make the $1,000. Interesting, every day I made at least $1,000. So every single day was winning. Every single day. But my P&L is pretty bad. You know, I only have $1,000 to make every day. How much money can you make? But you can see that how risk affects, you know, returns with the same exact model. Okay. And then let me see that I just don't like volatility. If I make 1,000, I'm out. If I lose 1,000, I'm out. So I'm putting a band, basically, my P&L. And you can see this here. It's just basically a band, right? P&L, even worse. 13,000. Why? Because probably the market goes past minus 1,000 often, and I'm out. I don't let the market go down and come back up. And I'm capping my upside as well. Winning versus losing looks okay. I'm making 2.6 more than I would otherwise. So the focus is to come up with a perfect balance, what I call the Goldilocks zone. You want to be able to find a balance between risk and reward. In this case, the safest approach was stop loss about 20 grand and a stop gain of about 2,000. Best combination, 28 to 16. I'll show you both those. Highest P&L is basically unbridled P&L. So this is like the safest middle ground. Again, I'm gonna have a stop loss of 21,000, stop gain of 2,000. Again, I'm winning every single day. Not making a lot of money, but it's safe, you know, making money every day. This is the best combination. Again, we're up to $500,000, 1.57 winning days. You know, this is basically what they were looking for. And then you have, you know, this nice band. And then this is back to the beginning. This is without any limits, without any risk. I'm willing to write it off and hope that nothing happens. What's interesting, I did one more scenario here, which is this, which gives me the exact same result as the previous one, but I'm capping my loss at 60 grand, which is interesting. If I were very risk prone, this would be interesting to me, okay? And I don't have an open loss problem here. Does it work? Yes, it works. I mean, I took this out of the economists, I think. We see this over and over and over. It does work. Some lessons. Number one, algorithms always need to be bound by reason. You will not believe the things I've seen over the past 20 years. People saying, we built an algorithm that looks at the faces of the moon and correlated with some stars. It's crazy stuff. People do come up with those models. They will break. They will break at some point. So you always need to have something that makes sense. If it doesn't make sense, don't do it. Avoid it. Second, they always need to be bound by risk constraint. The moment that you remove a human from trading, you're optimizing the process, but you're also removing a judgment point. There's nobody making a judgment whether you should make a trade or not. It's going to happen. So you have to build that in from the beginning. You need to build in from the beginning the limits that are going to act as if a human were there to make sure they're bound by risk, anything that happens in the system. The systems that break are the ones that don't have this properly done. Number three, complexity is your enemy. Can't tell you how many times people have models that are working. They don't understand what's in there. It's a black box. They will break. It will break, and something will happen sooner or later. Because you don't know how different changes in the marketplace are going to affect what happens there. 5, execution is a big part of performance. We spoke about that. 6, continuously adjust your models and verify your assumptions. You always have to say, hey, was this correct? Was my assumption about the market was correct? Was my assumption about the instrument was correct? Is my model, does my model make sense? You need to continuously go back and review. This makes sense or not. 7, I learned that with the first implementation we made. You need to have a panic button. What is that? Hit the button, all orders are closed, all positions are unwound. Sometimes something happens in the market, you need to hit the button and everything gets flat, quickly. Very important. 8, predicting is bad, arbitrage is good. If somebody could predict the market all the time, it's printing money. I don't know anybody yet who's be able to predict the market consistently. 9, on a risk-adjusted basis, taking lots of small bets is better than a large one. You never have too much of risk. You're always readjusting things. You have a lot more flexibility. 10, controlling risk is the key to long-term positive returns. You could have a model that makes money half of the time and loses money half of the time, and it still have a profitable strategy. How? You minimize the losses and let the gains run. And finally, speed does not beat intelligence. You need to have models that work. I think I'm going over here. You guys have any questions? Go ahead. Huh? This was in U.S. markets, U.S. equities. Servers, yeah. There are some exchanges that give you co-location, but nowadays, unless you're doing HFT, you don't need to be at the exchange. You could do it from anywhere.
So how do you succeed in arbitrage if there are a lot of companies that are actually deploying on the network cards?
Because not everything is depending on the speed. It's only one type of arbitrage that depends on the speed. There's a lot. I would say 80% of the arbitrage does not depend on the speed. Go ahead.
Are you sharing the slide deck?
Huh?
Will you be sharing the slide deck?
I think it's uploaded into the conference thing. I think you guys will get it.
Assuming now 10% of the audience what you exactly said, what you proposed, how will your model accommodate if half of the market doing the same thing that you are doing?
What do you mean? I'm sorry, I couldn't hear.
Half of the market, players in the market do the exact or do the thing you are doing with your strategy. How do you compensate for people doing the same strategy as you?
You change the strategy. I mean, when everybody's doing the same thing, it doesn't work, right? If everybody is following a mean or an average, it stops working, right? So you need to change it.
It works for you.
Huh?
Everybody does what you do, it works for you.
Well, the models could be the same, but the fact that you can have parameters which are different, either drive out of the data, makes the models totally different. You know what I mean? The data changes the models. The parameters change the models. Go ahead. Huh? It's not. Deep learning will give you insights and it'll give you models, but it doesn't mean you don't understand the models. You know, if you throw 3,000 variables to it, maybe you come up with something you don't understand, but if you narrow the variables to things that you know should work, then you come up with a model that makes sense, right? If it doesn't make sense, you need to use intuition a bit with this. If it doesn't make sense, you should not be using it, because you're not going to know what's going to happen when the market goes into an anomaly state. It's making sense from a model perspective. Does a model make sense? Am I trying to do something that makes sense, that it would work if it wasn't being driven by a machine? So, okay. Thank you, guys.